Mastering Fundamental Analysis by Michael C. Thomsett. Introduction. Hey friend, let's talk about something powerful today. Something that can completely change the way you look at investing. It's not about tips or fast profits. It's about understanding the real story behind a stock. That story is told through something called fundamental analysis. And Michael C. Thomsett has written a brilliant guide that helps us decode that story. His book, Mastering Fundamental Analysis, is like sitting with a wise mentor who doesn't just teach theory, but gives you real tools to master the market. So today, let's go through this book, step by step, chapter by chapter, and by the end of it, you won't just know how to analyze a company. You'll feel confident, calm, and clear. Let's begin. Chapter 1, Understanding Fundamental Analysis. Let's begin with a simple thought. Before you buy a stock, you must know what you're really buying. And that's where fundamental analysis comes in. It's not about guessing the price. It's not about chasing trends. It's about understanding the truth behind a business. It's about seeing a company as if you were buying the entire thing. Not just a share, but the whole company, its products, its leadership, its reputation, its numbers, everything. Michael explains this beautifully. He says, imagine you are going to buy a small bakery. Would you just look at how many people are outside? No, you'd want to know more. How much profit does it make? How much does it owe? Is the rent too high? Is the owner honest? Will the business survive hard times? That's exactly what fundamental analysis does. It looks deep inside the company. It starts with the basics. How much does the company earn? How much does it spend? Is it making profits consistently? Does it have too much debt? Or does it hold strong cash reserves? These aren't just numbers. They are signs of strength or danger. Michael says, don't buy a stock just because everyone else is buying. That's not investing. That's following the crowd. And crowds often run towards cliffs. Be the one who checks the map, who studies the ground, and who moves when the path is clear. Fundamental analysis isn't about speed. It's about clarity. It gives you the power to say no to bad companies, to say yes to strong businesses, and to wait when things are not clear. Michael talks about two types of investors. One invests with emotion, the other with understanding. Guess who survives in the long run? It's the one who trusts the process, not the noise. The one who reads financial statements, not headlines. The one who looks at value, not just price. This chapter sets the stage. It tells us, you don't need to be a genius. You just need to be curious and consistent. Ask questions. Look deeper. Understand the business. That's what great investors do. Michael shares something powerful here. He says, a stock is not just a piece of paper. It's ownership. It's responsibility. When you invest in a company, you are trusting it with your money. Wouldn't you want to know if that trust is deserved? That's the heart of fundamental analysis. It's not about being perfect. It's about being prepared. It's not about predicting the future. It's about reading the present wisely. And that wisdom begins with this very first step, understanding what fundamental analysis is. So, my friend, before you jump into any trade, pause. Ask yourself, do I understand the company behind this stock? If the answer is no, then wait, study, learn. Because when you truly understand, you don't just invest, you invest with confidence. That's how you begin the journey of mastering fundamental analysis. And trust me, it's a journey worth taking. For your future, for your peace of mind, and for the wealth you're building slowly, wisely, truly. Chapter 2, The Importance of Financial Statements. Let me ask you something. If someone told you to invest your life savings into a business, wouldn't you want to see the books? Wouldn't you ask, how much do you earn? How much do you spend? How much debt are you carrying? That's exactly what financial statements help us do. They are the truth tellers of a company. They speak in numbers, but they reveal much more. Michael explains, if you want to be a serious investor, you must get comfortable with these three core documents. The income statement, the balance sheet, the cash flow statement. Each of them is like a mirror, reflecting a different side of the business. Each of them tells a part of the story. And when you put them together, you get the full picture. Let's begin with the income statement. It tells you how much money the company made and how much it spent. It shows you profits, but also reveals if the profits are real or just temporary illusions. Because sometimes a company might show earnings, but those earnings might be based on one-time events or aggressive accounting. The income statement helps you dig deeper. Then comes the balance sheet. Think of this like a snapshot of a company's health. On one side, what it owns, assets. On the other, what it owes, liabilities. And in between, what's truly the shareholders' equity. Michael says this is where many investors go wrong. They focus on profits, but ignore debt. And when a crisis hits, debt is what drowns even profitable companies. The balance sheet shows you if a business can survive storms, or if it's walking on thin ice. Next is the cash flow statement. This one is special, because profits can lie, but cash flow rarely does. A company may report profits, but what if there's no cash in the bank? How will it pay suppliers? How will it grow? Cash from operations tells you, is this business generating real money, or just painting a pretty picture on paper? Michael reminds us again and again, cash as reality, profits are just a story. These statements may look complex at first, but you don't need to be an accountant. You just need to know what to look for. Michael breaks this fear. He simplifies it. He says, these reports aren't written to scare you. They're written to inform you, to empower you, to help you see the company for what it truly is. Most people never read them. They buy stocks based on tips or trends. But you're different, because you care about what's under the hood. You care about facts, not just forecasts. That's what sets wise investors apart. Financial statements also reveal red flags, like declining revenue, increasing debt, falling margins, or sudden drops in cash flow. These are not just numbers. They are warning signs, signals telling you something is wrong. And if you ignore them, you risk everything. Michael shares something powerful here. He says, reading financial statements is not optional. It's essential. It's not just about finding great companies. It's also about avoiding disasters. Because in the stock market, avoiding losses is just as important as making profits. You don't need to memorize every line. Just understand the structure, the flow, what each report means, and how they connect. Michael teaches this step by step, with clarity, with patience, with kindness, like a mentor. So, my friend, don't be afraid of numbers. They are not your enemy. They are your allies. Once you understand how to read them, you won't feel lost anymore. You'll feel empowered, calm, clear, because now, you'll see the truth behind the ticker. And when you see clearly, you invest fearlessly. That's the beauty of this chapter. It doesn't just teach accounting. It teaches you how to listen to what the company is really trying to say. And that is the foundation of smart investing. Chapter 3, Reading the Income Statement. Let's take a closer look now at the first and most talked about financial statement. The income statement, also called the profit and loss statement. It shows how much money a company makes and how much it spends over a period of time, usually every quarter or every year. It starts with revenue, also called the top line, because it sits at the top of the statement. This is the total money the company earned from selling its products or services. But remember this, big revenue doesn't always mean big success. Because what matters more is what's left after the expenses. After revenue comes the cost of goods sold, or COGS. This is the cost of making the product, like raw materials, labor, manufacturing expenses. You subtract COGS from revenue, and you get gross profit. Gross profit tells you, after making the product, how much money is left. A higher gross profit means the company has pricing power. That's a good sign. But the journey doesn't stop there. Because companies have many other expenses. They pay for salaries, rent, marketing, technology. These are called operating expenses. You subtract operating expenses from gross profit, and what you get is operating income, also called EBIT, earnings before interest and taxes. This number shows you how profitable the core business is, without including financing or taxes. Now come the non-operating items, like interest paid on loans, or interest received from investments. You also subtract taxes here. And finally, you arrive at the most awaited number, The net income, also known as the bottom line. This is the final profit. The amount the company actually made. After everything, this is the number that shows up in news headlines. But Michael tells us something important here. Don't just focus on this bottom line. Because even a profitable company can be in trouble. Let me explain. Sometimes profits rise, but revenue is falling. That could mean the company is cutting costs too much. Maybe they're firing staff or reducing investments. That's not always a good sign. Sometimes a company may sell assets and show a temporary profit boost. But that's not from business operations. That's not sustainable. Michael warns us. Don't fall for pretty numbers. Look for consistency. Look for transparency. He also teaches us to look at margins. Gross margin, operating margin, net profit margin. Margins tell you how efficiently a company turns revenue into profit. A company with rising revenue but shrinking margins is losing efficiency. But a company with stable or growing margins, that's strength, that's control, that's a good sign. One of the best things about this chapter is how practical it feels. Michael isn't just giving theory. He shows you how to look for clues. How to compare this year's income statement with last year's. How to spot trends. How to ask questions. Why did expenses go up? Why did profits drop? What changed? Because behind every number is a decision. And you, as an investor, need to understand what's really going on. Michael also talks about something most people ignore. Earnings per share or EATs. It tells you how much profit is made for each share you own. Rising EATs over time, that's a strong signal. But if the company is buying back shares just to boost EATs, that's something to investigate. Because numbers can be shaped. But truth is revealed when you ask the right questions. Here's another lesson from Michael. Don't get distracted by one good quarter. Look for patterns. Look for stability. A great business doesn't just shine once. It keeps shining, even when the market gets cloudy. That's the kind of business you want to hold. He also shares a golden rule. Trust performance, not promises. Don't fall for press releases. Look at the income statement. Because that's where the real story lives. And once you know how to read it, you'll never see a company the same way again. So my friend, don't worry if this feels new right now. It takes time, but slowly, you'll start recognizing good signs, red flags, trends, and you'll begin to see clearly where others just guess. That's the power of learning how to read an income statement. It's not just about numbers. It's about confidence, about knowing what you are doing and why you are doing it. Chapter 4, Interpreting the Balance Sheet. So far, we've talked about income, about profits, about how much a company makes. But now, let's talk about something even more important. What the company owns, what it owes, and how strong its foundation really is. That's what the balance sheet reveals. Michael says, think of a balance sheet like a photograph. A snapshot of the company's health. Taken on a specific day. It tells you what the company has and what it must give back. The balance sheet has three parts. Assets, liabilities, shareholders' equity. Let's break them down, slowly, clearly, together. 1. Assets, what the company owns. These are the things that bring value. Things that the company controls. Cash, buildings, machinery, inventory, money owed by customers. All of that. Assets are divided into two types. Current assets and non-current assets. Current assets are short-term. They can be turned into cash within a year. Cash in hand, accounts receivable, inventory, short-term investments. These are the lifeblood of daily operations. If a company doesn't have strong current assets, it may struggle to pay bills. Non-current assets are long-term. They include property, factories, long-term investments, patents, things that can't be quickly converted into cash, but are still valuable. 2. Liabilities, what the company owes. These are the obligations. The money a company must pay. To banks, to suppliers, to employees. Just like assets, liabilities are also split into two. Current liabilities and long-term liabilities. Current liabilities are due within a year. Like accounts payable, wages, short-term loans, taxes. These can cause serious problems if cash is tight. If liabilities rise and assets shrink, that's a red flag. Long-term liabilities are due after a year, like bonds, mortgages, pension obligations. If a company has too much long-term debt, it may seem okay now, but it could be heading toward danger. Michael reminds us, debt is not always bad, but uncontrolled debt is poison. 3. Shareholders' equity, what's left for the owners. Now comes the final part. Equity, also called net worth. It's simple. Assets, liabilities equals equity. This is the company's real value. After paying all debts, this is what belongs to the shareholders. To you and me. If you own a share, you own a small piece of this equity. But here's the thing. Michael warns us not to stop at just the totals. Look deeper. Check how these numbers are changing. Is the company taking more loans every year? Is equity shrinking? Is it burning cash to stay afloat? These patterns matter more than one-time profits. One of the most powerful indicators, debt to equity ratio. It compares how much the company owes to how much it owns. A high ratio means the company is heavily dependent on debt. In good times, it might grow fast. But in bad times, it might collapse. That's why investors love low-debt, high-equity businesses. They're safer, more stable, and more reliable over time. Another key number, current ratio. It compares current assets to current liabilities. A ratio above 1, good. It means the company can pay its short-term bills. A ratio below 1, worrying. It may signal a cash crunch. Michael teaches us, these small numbers tell powerful stories. He also talks about book value. This is the value of the company according to the balance sheet. If you sold everything and paid off every debt, what's left is the book value. It's different from the market value. And sometimes, a company trading below book value can be a hidden gem. But only if the business is healthy. This chapter is not about fancy math. It's about awareness, about looking at the structure of the business. Strong companies have strong balance sheets. They don't collapse easily. They survive recessions, and they protect your investment. Michael makes one thing very clear. If the income statement is about performance, then the balance sheet is about stability. And in investing, you need both. You want growth, but you also want safety. The balance sheet tells you if the company has a strong backbone, or if it's fragile under pressure. So my friend, don't be afraid to look at the balance sheet. Don't ignore it. It's not just for accountants. It's for you, for every investor who wants to know the truth. Because once you understand this statement, you won't just be guessing anymore. You'll be evaluating, you'll be measuring risk, and most importantly, you'll be investing with clarity and confidence. That's the goal. That's the gift of Chapter 4. Chapter 5, Analyzing Cash Flow. Let's get real now. You've seen companies showing profits, making headlines, impressing investors, but still going bankrupt. How? Because profits aren't everything. Cash is. And that's exactly what this chapter is about. Michael says something that sticks with you. Cash as truth. Profit as opinion. Let that sink in. Because while profits can be manipulated, cash flow shows what's actually happening. It tells you how much real money is coming in and going out. No tricks. No accounting games. Just the truth. So what is a cash flow statement? It's a report that shows how money moves through a company. It's divided into 3 parts. Operating activities, investing activities, financing activities. Each one tells a different story. Let's go through them, one by one. 1. Cash flow from operating activities. This is the heart of the business. It shows how much cash the company generates from its core operations, selling products, providing services. If this number is positive, it means the company is actually earning real cash. Not just on paper, but in the bank. But if this number is negative, even if the income statement says the company is profitable, that's a red flag. It means money is being used up faster than it's earned. And no matter how profitable a company looks, if it runs out of cash, it can't survive. Michael puts it simply, a business that can't pay its bills can't stay alive. 2. Cash flow from investing activities. Now this part tells us about the company's long-term moves. Buying buildings, purchasing equipment, investing in other businesses. It also includes money made by selling assets. This section may show negative numbers. And that's not always bad. Because it might mean the company is investing in its future, it's growing, building, preparing. But if it's constantly selling assets just to stay afloat, that's a problem. That's survival mode, not growth. 3. Cash flow from financing activities. This one is about money from outside sources. Taking loans, raising money from investors, issuing stock, or paying dividends. It also shows when the company is repaying debt or buying back its own shares. These cash movements help us understand the company's strategy. Is it borrowing too much? Is it rewarding shareholders? Or just trying to stay alive? Now here's something powerful Michael shares. Always compare the net cash from operating activities with net income from the income statement. If they move together, that's good. It means the profits are supported by real cash. But if net income rises and operating cash stays flat, or worse, drops, it's time to ask questions. It may be a sign of aggressive accounting or a business losing real strength. Michael also talks about a key term, free cash flow FCF. It's the cash left after the company pays for everything it needs to operate. It's calculated as operating cash flow capital expenditures. If free cash flow is rising, that's a golden sign. It means the company is efficient. It has money left after paying all bills to reinvest, to grow, or to reward shareholders. This chapter is not just about numbers. It's about reality. Because even the strongest brand, the biggest name, the flashiest profit report, means nothing if cash isn't flowing in. Michael wants you to think like a smart investor. He wants you to ask, is this company self-sufficient? Is it generating cash from its own business? Or is it borrowing constantly? Selling assets, using tricks to look profitable. Once you see the cash flow clearly, you spot these things easily and protect yourself. So my friend, don't ignore the cash flow statement. Don't let the income statement fool you. Numbers can smile on the surface while hiding the cracks beneath. But cash flow, that's where the truth lives. That's where safety begins. Read it, understand it, let it guide your choices. Because cash flow is not just a number. It's life energy for the company and for your investments. This is the gift of Chapter 5. It gives you clarity, power, and peace of mind, so you never have to invest in the dark again. Chapter 6, Valuation Ratios and what they mean. Valuation ratios are the heart of every fundamental investor's strategy. Because at the end of the day, we all want to know one thing. Is the stock overpriced, underpriced, or fairly valued? But numbers alone don't tell the whole story. Let's walk together through this chapter, like two friends trying to understand what a company is truly worth. Price to earnings ratio (PA ratio). Let's start with the most famous one, PA ratio. It tells you how much people are willing to pay for 1 rupee of a company's earnings. If a company has a PA of 15, it means people are paying 15 rupees for every 1 rupee it earns. High PA could be growth, could be hype. Low PA might be undervalued, or maybe there's a hidden risk. You see, the PA is a glimpse into the market's belief. But belief isn't always truth. Always compare PA with industry peers. A bank's PA and a tech firm's PA are two very different animals. So never look at this number in isolation. Use it like a flashlight, not a final answer. Price to book ratio (PB ratio). Now imagine we shut down the company today. Sell everything. Pay all debts. What's left? That's the book value. The PB ratio compares the stock's market price to its book value. If PB is below 1, the market thinks the stock is worth less than its net assets. Sometimes that's a golden opportunity. Sometimes it's a trap. Maybe the company owns old equipment. Maybe the balance sheet is strong, but the business is dying. Again, you have to look deeper. That's what real analysis means. Not believing the number, but understanding the story behind it. Price to sales ratio (PS ratio). Next up, PS ratio. Sometimes, earnings lie. Companies can manipulate profits through accounting tricks. But revenue is raw, harder to fake. The PS ratio tells you how much you are paying for each rupee of sales. If a company has a low PS, it might be undervalued, especially if it's still growing. But it also depends on margins. A business with high sales but zero profit is like a shop full of customers who never buy anything. So look at the PS only when combined with other metrics. It's one piece of the puzzle, not the whole picture. PEG ratio, the growth factor. Now here's a smart twist on the PA ratio PEG. It adjusts the PA by factoring in growth. PEG equals PA growth rate. So, a PEG of 1 means the stock's valuation is in line with its growth. Below 1, that's attractive. Over 1, might be too expensive. But again, you must check. Is that growth real? Is it sustainable? Because the PEG can mislead if the growth forecast is too optimistic. It's like looking at the road ahead through foggy glasses. You see the direction but not the obstacles. Dividend yield and payout ratio. Some companies give back. They share profits. That's called dividend. Dividend yield tells you how much return you are getting in the form of dividends. If a stock is 100 rupees and it pays 5 rupees in dividends, the yield is 5%. Sounds good, right? But don't stop there. Check the payout ratio, how much of earnings are being paid out. If a company is paying 90% of its profits as dividend, it might not be left with enough to grow. So sometimes, a lower payout is better. Because reinvestment fuels future profits. Dividend investing is not just about income. It's about confidence. A consistent dividend tells you the company is stable. But chasing high yield alone can be dangerous. Be wise. Enterprise value F and market cap is just the beginning. Enterprise value F goes deeper. It adds debt, subtracts cash, gives you a more realistic cost to acquire the business. Then comes. This tells you how expensive the business is relative to its actual earnings, before interest, tax, depreciation, and amortization. It's especially useful when comparing companies across sectors, because it strips out financial structure differences. Below 8, usually good, but again context is everything. One sector's cheap is another's normal. Why valuation ratios matter? Valuation ratios are your toolkit, your compass in the financial jungle. They don't guarantee success, but they protect you from blind faith. They help you ask better questions. They stop you from chasing hype. Because a great company can still be a bad investment if it's overpriced. And an average company can give great returns if bought at the right time. This chapter teaches you to separate price from value, to pause, to reflect, and to never fall in love with a stock. Fall in love with logic, with reason, with clarity. That's how real investors survive and win. Chapter 7, Qualitative Factors in Analysis. Hey buddy, let's pause for a moment. Because numbers are great, but they don't tell the whole story. In this chapter, Michael Thomsett opens the door to something deeper. Something you can't always measure, but you can always feel. It's called qualitative analysis. And trust me, it matters just as much as the financial ratios we talked about earlier. Let's dive in. The human side of a business. Imagine two companies. Both have great revenue, low debt, and impressive growth. But one has a toxic work culture. And the other has a visionary leader who inspires everyone. Which one would you trust with your money? Exactly. That's where qualitative factors come in. They help you see the soul of a company, not just its bank balance. Key qualitative factors. Michael breaks these down into several powerful areas. Each one reveals a different truth about a company. Let's look at them one by one. 1. Management quality. A company rises or falls with its leadership. You need to ask, who's running the show? Do they have a track record of honesty, of success, of making smart decisions when things go wrong? Warren Buffett once said he invests in people, not just businesses. And it's true. A great team can turn around a failing business. But a bad one can destroy a great one. So always dig into the background of top executives. Read interviews. Watch how they speak during earnings calls. Do they inspire trust? 2. Corporate culture. Culture is invisible, but it's powerful. It shapes how employees behave, how decisions are made, how customers are treated. Look at Google or Apple, their cultures attract talent. Now think of companies with constant lawsuits, strikes, or scandals. That's bad culture, and it eventually hurts performance. So check reviews on websites like Glassdoor. Read employee testimonials. Look for signs of innovation, inclusivity, and ethics. 3. Brand strength and reputation. A strong brand is like armor. It protects a company during tough times. Think Coca-Cola. No matter what happens to the economy, people still buy it. Because the brand is trusted. recognized, loved. That's not something you'll find in a balance sheet. But it's a powerful qualitative asset. 4. Customer loyalty. Numbers can show how many customers a company has, but not how loyal they are. Loyal customers stick around. They keep coming back, and they tell others. That kind of loyalty creates long-term revenue even in tough markets. You can sense loyalty through online reviews, forums, and brand communities. 5. Innovation and vision. Is the company looking ahead or stuck in the past? Thomsett encourages us to look at R&D efforts, product launches, future plans. You want companies that build the future, not just those that maintain the present. 6. Environmental and social responsibility. More investors today care about ethics. And that's good, because companies that care about people and the planet tend to last longer. Check if the business supports green practices, how they treat workers, what causes they support. These things shape reputation and trust. 7. Competitive advantage moat. This is big. Does the company have something that no one else can copy? A secret recipe, a massive network, patents, great service. That's called a moat. The deeper the moat, the safer your investment. Because competitors can't easily invade. How to analyze qualitative factors. Now, here's the key. Unlike financial ratios, these don't come from a spreadsheet. They come from reading between the lines, from studying the news, listening to interviews, watching trends, visiting stores, talking to customers, even reading what employees say anonymously online. Combine numbers with the story. Michael says numbers are the skeleton, but qualitative factors, they're the heart. You need both. A company with great numbers but poor ethics. That's a red flag. A company with average numbers but a brilliant visionary team. That's a hidden gem. So always use both lenses, the quantitative and the qualitative. Final thoughts. Investing isn't just science. It's art. It's emotion. It's instinct. When you look at qualitative factors, you're not just investing in a stock. You are investing in a story. In people. In purpose. Never ignore that. Because at the end of the day, behind every company, there are human beings. Dreaming, building, and trying to change the world. So ask yourself, is this a company you'd be proud to own? If the answer is yes, you are doing fundamental analysis right. Chapter 8, Industry and Economic Influences. Every company is a part of something bigger. It doesn't exist in isolation. It breathes within an industry. And it reacts to the pulse of the economy. That's exactly what this chapter talks about. The impact of industry and macroeconomic forces on a company's performance. Let's walk through it like friends discussing the heartbeat behind business decisions. Start with the industry. Before you even look at a company's balance sheet, look at its industry. Is the industry growing, or is it struggling to survive? Some industries rise with time, like tech and renewable energy. Others face decline, like paper or coal. If you are analyzing a company in a shrinking industry, even a strong balance sheet might not save it in the long run. That's why context matters. Industry trends tell you where the tide is flowing. And you don't want to invest in a ship sailing against the current. Industry characteristics. Each industry has its own rhythm. Some are capital intensive. Some run on razor-thin margins. Some are heavily regulated. Some are extremely competitive. Understanding this unique fingerprint helps you make better sense of a company's numbers. A 5% profit margin in retail might be decent. But the same in software could be a red flag. So never compare across industries blindly. Always ask, what's normal here? Economic indicators, the bigger picture. Now shift your gaze to the economy. Is inflation rising? Are interest rates high? Is consumer spending slowing down? Each of these factors affects businesses. And ultimately affects the stocks you buy. For example, during high inflation, input costs go up, margins shrink, people spend less. Even great companies can suffer in bad economies. So timing matters. That's why economic analysis is part of fundamental analysis. You can't ignore the environment. Cyclical vs non-cyclical industries. Some industries ride the economic cycle. These are cyclical industries, like automobiles, construction, and luxury goods. When the economy is booming, they shine. When recession hits, they fall hard. Others are non-cyclical or defensive, like healthcare, utilities, and basic consumer goods. They remain stable even in downturns. That's why portfolio diversification across different industry types is smart. Balance the risk, spread the exposure. Global economic influences. In today's world, companies don't just operate locally. They operate globally. That means international events matter. A war in one country, a policy change in another, a supply chain disruption overseas. All of this affects stock prices back home. So being aware of global economic forces isn't optional anymore. It's essential. Regulatory environment. Industries are also shaped by laws and regulations. Government actions can either protect or pressure companies. New tax laws, environmental rules, trade tariffs. These things might not show up in a financial statement, but they change the game. So always look at what's happening behind the headlines. That's where real analysis lives. Putting it together, you don't analyze a company in a vacuum. You look at the entire picture. Company, industry, economy, global events. Only then do you understand what those numbers on paper actually mean. Because behind every ratio, there's a reason. Behind every trend, there's a story. And behind every stock, there's a world moving around it. That's fundamental analysis. That's how professionals think. Chapter 09, Putting It All Together, the Analytical Process. We've come a long way. You've learned the tools, the terms, the balance sheets, the income statements, the ratios, the industries, the markets. But now comes the real challenge. Putting it all together. Because analysis isn't just steps on paper. It's a mindset, a method, and a practice. Start with curiosity. The best analysts aren't just smart. They're curious. They ask questions. They don't settle for the surface. They look deeper. They want to know why. Why is this company growing? Why are expenses rising? Why is the stock underperforming? This is where true insight begins. Begin with the big picture. Always start wide. Look at the economy. Are we in a boom? A recession? How are interest rates? How is inflation? Next, look at the industry. What are the trends? Is demand growing? Are competitors rising? The company you are analyzing doesn't exist in a bubble. It swims in a sea of influencers. Understand the sea before you judge the swimmer. Then zoom into the company. Now, pull out those statements. Start with the income statement. Are revenues growing? Are profits stable? How's the margin? Then, the balance sheet. Is the company in debt? Is it managing assets wisely? What's its equity position? Finally, cash flow. Are they burning cash or generating it? A company may look good on paper, but if cash is tight, trouble is brewing. Now apply the ratios. Remember the key ones. P/E ratio tells you what investors are paying for earnings. Current ratio tells you if the company can pay its bills. Debt equity tells you how risky the financial structure is. Return on equity tells you if they're using shareholder money wisely. Compare these to past years, to industry averages, to competitors. Numbers don't lie, but they do need interpretation. Don't ignore qualitative factors. Fundamentals are more than numbers. Management matters. Brand strength matters. Customer loyalty matters. Innovation matters. What are people saying? What's the company's culture? Are they ethical? Are they visionary? Because the greatest businesses have a heart and a mission that shines beyond numbers. Develop your thesis. After gathering data, after crunching numbers, after reading reports, sit back and ask yourself, what is the story of this company? Where is it headed? What are the risks? What are the rewards? This is your investment thesis. Your personal conviction that tells you, yes, I want to own this. Or, no, this isn't right for me. Decide and act. Once you have clarity, don't freeze. Decide, buy, sell, or wait. And then, write down your reason. Keep a journal. Track your analysis. Over time, you see what worked and what didn't. That's how you grow. That's how you learn. That's how you master the process. And always review. The market changes. The world changes. Companies evolve. Your portfolio should too. Revisit your analysis. Update your conclusions. Adapt. Thomsett's golden rule. Fundamental analysis is not a one-time thing. It's a continuous process. Like tending a tree. The roots need checking. The branches need pruning. And the growth needs nurturing. Conclusion of chapter. This final chapter is a gentle reminder that knowledge is power, but only when used wisely. You now hold the tools, the process, the mindset, so build with patience, analyze with honesty, decide with clarity, and grow with time, because in this noisy world of speculation, you've chosen wisdom, and that makes all the difference. Chapter 10, Case Studies and Real-World Application. Sometimes, we learn best not from theory, but from real stories, real companies, real decisions, real consequences. That's what this chapter is about. It's where knowledge becomes wisdom, where charts turn into choices, and numbers meet reality. Michael C. Thomsett walks us through actual case studies. Not to impress, but to teach, to guide you, to show how the pieces of fundamental analysis work together in the real world. Let's dive in. Case Study 1, A Strong Balance Sheet but a Fading Future. There was a company, profitable, stable, with a clean balance sheet. No big debts, decent cash flow, but something was off. Its product was slowly becoming irrelevant. Like a VHS company in the age of Netflix. When you looked deeper beyond the numbers, you saw it. Declining sales, shrinking market share, no innovation. Investors who only looked at financial ratios were fooled. But those who read the story behind the numbers, they stayed away. Lesson: numbers tell you what has happened. The future depends on what's coming. Case Study 2, The Ugly Duckling That Grew Wings. This company wasn't pretty. Loss-making for years. Negative earnings. High debt. But something changed. A new CEO. A bold new strategy. New markets. Cutting old costs. Doubling down on strengths. If you waited for the numbers to look perfect, you'd have missed the upside. But a sharp fundamental analyst saw the turnaround signs. Looked at qualitative factors, management quality, strategic vision, and invested early. The stock tripled. Lesson: good analysis isn't about perfect numbers. It's about catching the shift before it becomes obvious. Case Study 3, The Trap of High Earnings. On the surface, everything looked perfect. Rising profits, skyrocketing stock price, positive sentiment. But when the analyst dug deeper, he found something strange. Most profits came from one-time gains, not core operations. Inventory levels were bloated, receivables were climbing, the warning signs were flashing. But many ignored them. The company crashed within a year. Lesson: not all profits are created equal. Always look beneath the headline. The process in practice. Through these case studies, Thomsett reminds us, fundamental analysis isn't about memorizing formulas. It's about building a full picture. Looking at the income statement and asking, is this sustainable? Checking the balance sheet and wondering, is the company healthy or hiding something? Reading annual reports, listening to earnings calls, following the industry, and staying alert. Every company is a story. Numbers are the language, but meaning comes from how you interpret them. A note to you, my friend. By now, you know the tools. You've learned the ratios. You understand the balance between numbers and vision. But here's the secret. The real edge is in your mindset. Your patience, your curiosity, your ability to say, I don't understand this yet. Let me dig deeper. That's what makes a great investor. That's what turns knowledge into profit. And that's what this book prepared you for. So go out there, read the stories behind the stocks. Ask the questions others ignore. And invest with clarity, not with noise. Because now, you're not just buying stocks. You are owning pieces of a business. With purpose and understanding. Chapter 11, Mistakes to Avoid. We all make mistakes. But in the world of investing, some mistakes can cost a lot. Not just money, but confidence and years of hard work. This chapter is like a flashlight. It shows us the dark corners we often miss. Let's walk through it together, like friends. 1. Relying too much on earnings alone. Earnings are important, but they don't tell the full story. A company might show rising profits. But what if they're taking on dangerous debt? Or selling assets just to boost income? Don't fall for surface-level numbers. Always ask, how are these profits being made? 2. Ignoring cash flow. Profits can be manipulated. But cash flow, that's raw and real. You need to see where the money is going. Is it coming in steadily? Or is the company bleeding quietly? Always look at cash from operations. That's the heart of a healthy business. 3. Overlooking the balance sheet. Many skip the balance sheet because it's dry or too technical, but that's where the skeletons hide. Too much short-term debt, declining assets, rising liabilities. All red flags live here. Take a slow breath and read the balance sheet line by line, like reading the truth hidden beneath layers. 4. Chasing trends instead of value. It's easy to get pulled in when everyone's buying a hot stock, but trends are loud and value whispers. Don't chase hype. Look for strong fundamentals. What is the company really worth? Not what people say it is. 5. Not understanding the business. You might know the ticker, but do you know the company? What do they make? Who buys it? What's their risk? Are they future ready? Warren Buffett says, never invest in a business you don't understand. And he's right. 6. Failing to think long term. If you are checking stock prices every hour, you're not investing, you are gambling. Fundamental analysis works best with patience. Think in years, not days. Let your decisions breathe. 7. Falling in love with a stock. This is a big one. Sometimes, we get attached to a brand, a CEO, a company we admire, but markets don't care about feelings. Always be willing to walk away, no matter how much you like it. Stay rational, stay grounded. 8. Ignoring external factors. You can do all the math, all the analysis, but then, a recession hits, or a regulation changes, or a global crisis strikes. Don't isolate your analysis. Always include macro factors. Zoom out before you zoom in. 9. Not having a margin of safety. Even the best research can be wrong. That's why we need a cushion. Buy when the stock is undervalued. Give yourself a buffer, so even if things go wrong, you're protected. 10. Not reviewing and learning. Many investors move on after a trade, win or lose. But every trade is a teacher. What went right? What went wrong? Write it down. Review it. Grow from it. That's how wisdom is built. Final thoughts from the chapter. Mistakes are part of the journey. Even pros make them. But when we reflect, when we stay humble, we evolve. Thomsett isn't just teaching analysis here. He's teaching awareness and self-discipline. That's the real edge. That's what sets great investors apart. Chapter 12, Creating Your Own Strategy in more detail. You've come a long way. You've understood the numbers. You've looked at companies inside and out. Now it's time for the most important part. Creating your own strategy. Because in the end, you're not here just to learn. You're here to act. You're here to build something that works for you. Let's begin. Start with your goals. Do you want slow and steady growth? Or do you want faster returns with more risk? Your investment strategy must match your dreams. If you want peace of mind, your portfolio should reflect it. If you're young and bold, your choices might look different. There's no one-size-fits-all strategy. There's only the one that fits you. Next, decide your style. Are you a value investor, looking for companies trading below their worth? Or are you a growth hunter, chasing the next big story? Maybe you like dividends. Maybe you like turnarounds. All are valid, but you must choose. Because clarity brings confidence, and confidence brings success. Define your tools. Use fundamental analysis as your compass. Look at earnings, debt levels, margins, assets, and not just for one quarter but over time. Trends tell stories. Numbers whisper truths. Listen to them. Don't forget qualitative insight. What's the company culture? Is management honest? Is the brand strong? Does it innovate? Do customers love it? These aren't found in balance sheets. But they matter deeply. Because people run businesses. And people shape success. Set your rules. Decide in advance. When will you buy? When will you sell? What will make you walk away? Rules protect you from emotion. They're your shield. Because the market plays with hearts. Don't let it play with yours. Backtest your strategy. Use past data. See how your plan would have performed. Don't expect perfection. Look for consistency. Look for logic. And most of all, look for belief that you can trust your process. Monitor, adjust, learn. The market changes. You will change too. So must your strategy. Not every tweak means failure. It means you're growing. You are evolving. And that's what smart investors do. They stay humble. They stay curious. Most of all, don't blindly copy others. What worked for Warren Buffett works for Warren Buffett. You're not him. You're you. So build something authentic, something that lets you sleep at night, something that reflects your values. That's your true edge. And remember, this journey isn't about beating the market every day. It's about understanding what you are doing. It's about walking into every investment with eyes open. And it's about building wealth that aligns with your life. You're not just mastering analysis. You are mastering yourself. And that is where real success begins. Outro. So friend, now you know what lies behind the curtain. Behind the tickers. And the noise. There's logic. There's truth. And there's a company trying to tell you its story. Michael C. Thomsett, through Mastering Fundamental Analysis, gives you the tools to understand that story, to invest with confidence, and to grow with patience. Don't rush. Don't guess. Just read, research, and trust the process. Because wealth isn't built in days. It's built with decisions. One clear decision at a time. This was a book summary by ABD of Finance. For more deep, emotional, and powerful insights, stay with us, because we don't just share summaries. We build understanding.